is Robin View. I'm the Editorial Director and Chief Economist at the Economist Intelligence Unit. I'm sure since you're all here, you'll know who we are, but just in case, I should explain that we are the business-to-business arm of the Economist Group. I'm sure you're all familiar with the Economist magazine or newspaper, as we call it. And we work with companies and actually with other organisations, academic institutions and governments themselves, about helping organisations operate more effectively internationally. So we help businesses particularly operate cross-border. In the context of China, we have quite a big operation here. We have a regional office in Hong Kong and another one in Singapore, but here in mainland China, we have quite a big office here in Shanghai and an even bigger one up in Beijing, and we do a lot of work on China, not just at the national level, but also at the provincial and indeed at the city level. We analyse almost 300 cities in China, helping clients understand opportunities there. So we help businesses who are outside China understand the opportunity and some of the issues that people have operating within this market. We also, though, work with Chinese firms who are looking to operate more effectively outside of China. So we do a lot of work with Chinese businesses, helping them think about the opportunities in sub-Saharan Africa or Latin America, and increasingly now, of course, in the markets of Europe and North America too. During the course of today, you're going to be hearing from a variety of people. You'll hear from me, first of all, on the global backdrop, a little bit about China operating around the world. But you'll also be hearing on the EIU experts who will be talking about the Africa situation and what opportunities that poses for China, about Latin America. My colleague Robert Ward, that I suspect many of you know, will talk about what's happening in the Eurozone and how that might create opportunities for China. We also have some special sessions on industries, so we'll be talking about the retail sector and the automotive sector, about branding for Chinese firms, and also about the opportunities for the financial sector. Those sessions will be breakout sessions, so they won't be happening here, they'll be happening outside in rooms on this floor, which will be immediately after lunch. Lunch, when that arrives, will be one floor down from here in an Italian restaurant, Favola Italian restaurant. Now, during the course of today, I think these sessions that we will be having will be most powerful if we engage with you. So every session has lessons time at the end for Q&A, and I would encourage you all to participate in that process. We will bring you microphones so everyone can hear you. You can ask questions in either English or in Chinese. We have simultaneous translation. You should all have headsets on your desk. Some of the speeches that you'll hear today will be in English, others will be in Chinese. The translation will be simultaneous. The slides will all be in English on the screen, but if you look in the pack, you'll find that there are Chinese translations of all the slides, so you can follow in the language of your choice. I would ask you, though, to leave your translation devices on the table when you leave, including when you leave for lunch, because they will be taken down to the breakout room so that you can have them down there if you need them. Now, in your pack, you'll find a yellow piece of paper, this one here. This is very important. It serves two purposes. One is for us to get some feedback on the event. You'll see you have an opportunity to rate every speaker, including me, so please take advantage of that. It's very helpful for us when we're planning these to understand whether we met your needs or not. It's also an opportunity for you to request to see some more of our services, and for anyone who fills one of these forms in, we will give you a USB stick which contains a copy of our latest Chinese country report as a thank you for doing so. The other thing that we're doing today is we're offering free on-site consultations with some of our directors of custom research, our Director of Custom Research based here in Asia, and also two people who've come over, a director and the associate director who've come over from America, who specialise in helping businesses and look to operate in that part of the world. If you're interested in strategy, either about developing your businesses here in China, or you're thinking about expanding in other parts of the world, and you'd like to spend a little bit of time talking to one of our specialists who advise companies on some of the strategic issues that you might face if you look to operate internationally, then please just go outside to the reception desk and ask to be signed up to meet someone during the course of today. I recommend that you do that early, so you get in and sign at the first coffee break so that there's plenty of opportunity for you to find a slot that works for you. So I'd be very grateful if you could take advantage of that opportunity. Of course, in China, Twitter is not allowed, but there are ways around that. Some of you will be tweeting through BlackBerry. If you do tweet, then our hashtag for today's event is #EIU Shanghai 2012. So if you do find the opportunity to tweet, then please tweet under that hashtag, and everyone in the rest of the world who I know is following this online will be able to see what we're talking about. Now, with no further ado, I'd like to move immediately to my presentation, which is to really set the scene for what's going on around the world, and then specifically some of the issues that I see as happening for China as China starts to globalise. So if we could just flip from this to my first slide, thank you very much. Hyper-globalisation, opportunities for Chinese international M&A. So I'm going to start, and this presentation has two halves. I'm going to start by talking a little bit about the global economic backdrop. I'm not going to say too much about that because we have some sessions during the course of the day which focus in a lot more detail on particular regions and talk in a lot more detail about the opportunities that developments in those regions may create for business. But I do think it's important when we're having a meeting like this that we start with a broad backdrop for the global economy. It's clear we're all operating within the context of global demand. It's important that we all start from the same place around what's going on. And I would say that this year, 2012, and indeed beyond that, is likely to be rather difficult for the global economy. I noticed that over the night, the IMF have just released their global economic forecast. They've upgraded it slightly. You've probably seen that in the news this morning. They're now a little bit more optimistic than we are about the outlook for the world, but not very much more optimistic. And I think perhaps the more interesting point is that they still are saying that global growth is going to be pretty sluggish relative to that we experienced on average over the last 10 or 20 years or so. From our perspective, we're looking at a European recession with quite a large number of countries in Europe contracting, possibly for the whole year in the case of some markets, but certainly for the first half of the year in the case of many countries. So Western Europe likely to be struggling. This market, the second biggest economy in the world, still stressed. As we all know, the economy here is slowing. We've had GDP data out very recently, which perhaps disappointed some market expectations, although I have to say was actually modestly better than our Chinese analytical team had predicted. But China is slowing because of deliberate government policy action, as well as because of what's happening around the world. Our belief is that China has the means to keep going. We certainly are not expecting to see a hard landing here in the Chinese economy. But I think it is important, and clearly it's a very clear backdrop for your businesses, that this market is certainly quite a bit softer than it was 12 or 18 months ago. And I think the US may surprise somewhat, perhaps a little bit on the downside, that some of the more recent data has been a bit optimistic. The jobs market has started to turn around, that there's a sense that perhaps things are getting better. But if you listen to what the Federal Reserve Board is saying, the US central bank, they still are very cautious, and we believe that that's appropriate. When we look at what's happening in America right now, we can see good reasons why the US has had a rebound over the last 6 months or so, but we still remain pretty cautious about its longer-term prospects, and we think that the US may be a little bit more disappointing than many people are wondering. So, in terms of the global backdrop, not a disaster, apart from perhaps for Western Europe, but certainly a little bit less rosy than we would ideally like. When you look at the risks around the global economy, there are plenty of things out there which are keeping us awake at night. Oil is one of them. Oil prices, depending on the one that you are focused on, we tend to look at Brent as a global benchmark, around $120, $125 a barrel. Prices at that kind of level are a tax on economic activity. They're a drag on the global economy, and of course on top of that we have issues around Iran and the international community's approach to dealing with Iran's nuclear program, and the belief that it may have a nuclear weapons program creates a risk premium in the market, and of course creates a risk that we may see prices spike further. And then in the context of Europe, I think it's very important to note that the European financial crisis has not gone away. In fact, one of the reasons I suspect the IMF has just revised up their forecast is it takes quite a long time for the IMF to move from finalising the numbers to actually getting their report into the market. And over the course of those last few weeks, mood has moved again in Europe, perhaps to be rather more negative. People now becoming more worried about Spain, more worried about Italy. We have remained worried throughout, and we are continue to be concerned that the European breakup, or Eurozone breakup, is a scenario which we continue to attract a relatively high probability to. So we are real concerned about Europe as well as about what's going on in the energy markets. Quite a lot of emerging markets are going to struggle a bit this year because we see this weakness in China, this weakness in Europe, as being a drag on other emerging markets too. We have these diminished expectations for the richer economies around the world. So the backdrop is not as good as perhaps we would ideally like. That creates a few trends which I think businesses need to be aware of and respond to. In terms of the big global trends, this economic environment that we're seeing at the moment is allowing this continued shift in the centre of economic gravity towards the east. I mean, specifically towards this market in China, but actually towards other emerging markets in this part of the world. So we see the softness in Europe, the softness in America, and the relative strength, and in some cases absolute strength, in the emerging markets, leading to this gradual shift in the centre of economic demand, particularly to Asia, to a lesser extent to Latin America and the Middle East as well. That's a trend which we believe will continue in the long term, and it has big implications for our clients all over the world. Second trend we would identify, and I'm going to talk about it quite a lot in a few minutes, is hyper-globalisation. Globalisation up until this point has really been an industrial country game, that we see multinational corporations coming out of Europe, coming out of the Americas, and investing quite heavily in the emerging markets and seeking to profit from the demand that they see here, and in some instances the more competitive cost base that they see here. But increasingly now we're seeing emerging market multinationals leave their home country and invest more significantly overseas. From China we're seeing a lot of investment into Africa, into Latin America, and some investment going into the more advanced economies of Europe and North America too. India, I think, slightly ahead of the game there, but certainly a lot of investment from the emerging world going out into the rest of the global economy, and that many of the things that emerging multinational businesses from the West have done over the last 20 years, I would expect to see emerging market companies from here do over the next 20 years. And then a sense that there is something of a battle of ideas going on around the world at the moment. One is a battle between East and West on how best to run your economy. And certainly in this particular market, I talk to policymakers here a lot, a very strong sense that the Western economic model is broken, and that China has a better idea of how to run its economy than the West has. Now, I have some issues with that as a characterisation, but it's clearly true that the policy stance that we see here and in other emerging markets is different from the one that we see in the West. And if this is the world's second biggest economy, and likely to become the biggest economy over the course of the next 10 years or so, what people here think about in terms of running their economy really matters for how we run our businesses. And then the other issue, the other battle of ideas I expect to see being fought out over the course of the next 10 or 20 years is between the young and the old. Very clearly something that's happening right now in the Middle East. So if you look at the Arab Spring, that could be characterised as an uprising by the young against ageing authoritarian regimes. But you also see this happening in the West as well. The battle is somewhat different. It's fought over tax and benefits, but pension contributions or pension rights, entitlements are very high in Europe and in America. Healthcare commitments are very expensive, being paid for by actually a relatively small group of workers. Changes in demographic profile means there's a lot of elderly people in those developed markets, not many people in work, and that's creating increasing tensions over the size of the promises which have been made in terms of provision for the elderly, and the small number of people who are going to have to pay for them, and I expect that to create frictions, fiscal policy frictions, over the course of the next 10 or 20 years or so. Those are big global issues. The trends for business, I think, well, clearly business is geographically refocusing. You are all here because this market is very interesting and probably more interesting to you than it was 10 or 15 years ago. Business is needing to learn to do more with less. It's a theme for business everywhere at all time, but never more so than today, as we see very cost-efficient emerging market companies becoming increasingly competitive on the global stage, means that businesses need to run themselves leaner and leaner. And then many companies that we work with needing to find a balance between surviving today, hunkering down, trying to make sure that they can remain cost competitive against very aggressive competition, particularly in this part of the world, and need to invest heavily in the future, which often means actually placing bigger bets into Asia, into Latin America, into the Middle East, and finding the financial resources to do that at a time when they're actually struggling just to make their day-to-day operations profitable. The long-term consequences of all that are shown in this graph. The G7, you all know, that's America, that's Germany, that's Japan, the UK, France, those big industrial countries. The E7 you probably don't know, but that's the BRIC economies, Brazil, Russia, India, China, plus the next three big ones, Mexico, Turkey and Indonesia. Today, the G7 industrial countries collectively are much bigger than those emerging seven. By the time you get out to 2030, those the biggest seven emerging economies in the world will be quite significantly bigger in aggregate than the G7 economies will be. That's something which will affect everybody's business everywhere in the world. Much of the work that the EIU does is around helping companies prepare for this change, because clearly continuing to focus on big strategies which drive all your revenue from those industrial countries is not going to work in an environment where the emerging markets become as significant as this graph suggests. Now, what I want to do for the rest of my remarks is just to focus a little bit on China specifically, and the way that as China develops, it's starting to realise some of its global ambitions, particularly global ambitions for its corporate sector. And the first thing to point out is that actually over the course of the last few years, China has become already a much more significant force on the global stage. China was the 6th largest international investor in the world in 2011, clearly the biggest emerging market foreign investor by some considerable margin, but the 6th largest international investor at all of all countries in the world during the course of last year. The level of China's overseas engagement has soared. Chinese business now do about 200 international M&A deals a year, and those deals are worth about $40 billion US, and you can see from the graph there, which is the graph of the number of outbound M&A deals that Chinese firms are doing, that we've seen a sharp change in China's international engagement in terms of corporate acquisition, and we would expect that to continue. Indeed, it's government policy that it continues. Who are the targets? Well, the top targets have been Canada, the UK, Australia, the US, more recently other emerging markets too, Brazil, Argentina. A lot of these deals have been about resources, and no great surprise there, a lot of Chinese firms going overseas in order to buy into the energy sector, the metal sector, and issues like that. So China is already becoming a significant force on the global stage in terms of its international acquisition program. Now, how good is China at actually going overseas and acquiring assets? Well, it depends on how you look at the data. Certainly when you look at deals which get to the offer stage, or when you look at Chinese firms that actually make an offer to acquire a foreign business, almost all of those succeed. About 87% of Chinese firms that make an offer for a foreign business actually follow through and complete the deal. 13% of them fail after we get to the offer stage. Why do they fail? We'll talk about this in a little bit more detail in a minute, but some of them are blocked by foreign regulators. That's a particular problem for China, and we'll focus on that in a second. Some of the deals are withdrawn just because of changing market conditions. That's not unusual. We see that happening all around the world. But you would imagine from that first set of bullet points that China's pretty good at going out and undertaking international M&A. But actually, I would argue that is not the case. While it's pretty good by the time it's made an offer at actually going through and completing the deal, most Chinese firms that look internationally and hope to acquire actually fail to get to the offer stage in the first place. Now, why does that happen? It happens for two reasons. Either they can't find a good target, so they have an idea about what they want to buy, but they are unable to identify a company that fits that profile, or they can't agree a price. But one of the problems that we see very specifically when Chinese firms look to acquire overseas is the pace at which Chinese businesses move when they're trying to undertake these sorts of transactions. Chinese firms tend to do their due diligence rather slowly, so it can take quite a long time for them to get comfortable with the acquisition target. Their risk assessment can be pretty long-winded. It takes weeks for them to do something that we see industrial countries often do in days. And a big problem for Chinese firms is if they found an attractive target to acquire, all too often it's snatched from under their nose by a Western bidder, because the Western bidder is able to move faster. So one of the big problems that Chinese firms have is that they struggle to get through the due diligence phase fast enough to be competitive in an acquisition scenario. Now, why do Chinese firms acquire? Well, they acquire, about half of them they acquire in order to gain access to new markets. They're also acquiring to try and gain access to resources, that commodity story that we're so familiar with, or to buy intellectual property or acquire some kind of international brand. Yet when we talk to Chinese businesses about their feelings around their ability to execute acquisition effectively, almost all businesses believe that they lack the management capacity to actually handle outbound investment very effectively. And about a third, only about a third, feel that they know how to integrate a foreign acquisition at all. So Chinese firms, when they look to acquire internationally, Once they get to the offer stage, they follow through. Financing the deal is generally not a problem, but they often struggle to get to offer stage in the first place because it takes them a long time to get comfortable with the firm that they're acquiring, so they often are pipped to the post by another bidder. Why does it take them so long to get comfortable? Well, it's because the management team generally do not feel comfortable about their ability to execute business internationally, and that slows them down. What are the sorts of things that we believe Chinese firms should be looking at when they're thinking about making an international acquisition? Well, these are the sorts of things that we look at. We do quite a bit of consulting work with businesses in China who are looking to go internationally. These are the sorts of things that we help Chinese firms think about when they're looking to buy a target overseas. So we help them think through things like the market and product potential for the market they're trying to enter or the target they're trying to acquire, and that's partly around the macroeconomics, about incomes, about demographics, but it's also much more grittily about the industry, the sector, the competitive playing field, and ultimately the product. We also help firms think through issues around political stability and effectiveness in the countries that they're looking to enter. Often Chinese firms are looking to enter some very difficult markets, and we help them think through the implications of that. They have to think through business policy towards Chinese investment specifically, and that can vary very widely from one market to another. Issues of trade and currency restrictions, of tax and finance, of labour availability. Chinese firms often have real issues when they go overseas about labour, whether to take their own labour with them or to hire locally. Those things can be very contentious and really drive whether a deal can add value or not. And then issues of infrastructure, which are often a very big part of Chinese international M&A, because so much of that M&A is resource seeking. And then issues about targets. Is there a suitable target out there for our client? Can they afford to purchase it? Can they move fast enough, which is a really key issue? And then are they able to manage it effectively once they have owned it? Those are the sorts of questions that we're talking to Chinese firms about when they're thinking about going international. Now, given that it's so difficult to make an international acquisition, one of the things that we see Chinese firms starting to do, and it's a tactic which we see multinational firms from other parts of the world pursue very successfully, is to start their international engagement in a rather smaller way. Most of the world's biggest multinational companies often enter markets in the first instance through partnerships or joint ventures. Many of you here in the room today are representing Western businesses. You will have entered China using just those sorts of methodologies, either into some sort of JV and alliance, and perhaps done some buyout down the road. So not make your first step internationally an acquisition, but actually make it some kind of partnership or instead. There is now some evidence that Chinese firms are warming up to this as a strategy, and it's certainly a much less risky strategy. It also gets around some of the protection issues that we see facing Chinese firms around the world. That going in with a joint venture tends to be rather less contentious than going in with an outright acquisition. Means that some of the political problems that Chinese firms often face going international can be circumvented. And I think just to put two very clear contrasts, I'm not saying that either of these two deals, one is better than the other, but they're certainly very different. Beijing Automotive Industry Holdings, BAIC, when they look to acquire a foothold in the international automotive industry, they bought Saab's technology, but they did not buy Saab's plants, and they did not buy Saab's brand. That enabled them to move up the ladder in terms of production efficiency, but certainly was a much less contentious deal than Geely, who bought Volvo outright. That deal appears to have been very successful, but I would argue that's probably quite exceptional that they've managed to acquire an asset with such a high profile of that, with relatively political fallback. So entering in the first instance in a rather softer way and perhaps moving to acquisition later has a number of advantages, one of which is that later acquisition can often be friendly rather than hostile, which means it's considerably less contentious. Now, one of the things that China, it's not unique, but certainly China, I think, faces a rather acute case of are foreign fears about Chinese investment overseas. When China goes international, there are a lot of concerns by the private sector and by public sector around the world about the reasons for that and about the role of the Chinese government in that process. There are very few Chinese firms which are going international which don't have some kind of linkage back to the government, either some minority owning, they're receiving funding from some sort of state-owned development bank or something like that. And so there is a belief that Chinese investment is never wholly commercially driven, but always has some sort of geopolitical dimension, and in some instances that leads to concerns that Chinese international investment has some kind of national security dimension. Recently I was giving a speech in Miami for a conference that was supported by Telefonica, and I was doing a keynote, and immediately after me with the second keynote was a chap called Michael Rose, who's the CTO of Huawei. He's based in the US. Huawei has suffered greatly from concerns in America about the national security implications of it trying to tender for particular sorts of business. They've also just been pushed out of tendering for some deals in the Australian market too. Huawei is not the only Chinese business which has faced those sorts of accusations. It can be a real crimp on international ambitions. There are worries about Chinese acquisition activity overseas being driven by a desire to acquire proprietary intellectual property, or Chinese firms' respect for international property rights. Certainly if you talk to governments in Europe, or you talk to the US government, there is a bit of a fear that Chinese acquisition could lead to a hollowing out of intellectual property in those countries. So what does that mean for Chinese businesses? Well, certainly it means that Chinese firms need to take much more seriously the need to manage regulators and to manage public perceptions before they do a deal. And if possible, involving the target that they are attempting to take over. And I think that's true even if the deal is not national security related. I think it's important for Chinese firms to recognise that the nature of the Chinese economy and the belief internationally that the Chinese government sits behind any sort of international activity means that whether the deal is national security related or not, there is a perception problem, and that perception problem needs to be overcome, and it needs to be overcome proactively. And one of the things that Michael Rose from Huawei said is that if they had their time again, they would have handled their entry into the US market rather differently. And I think the really important thing here is to try and win the hearts and minds, not just of the target you're trying to acquire, but broader public perceptions in the country that you're trying to enter before you undertake the deal. Because after you've undertaken the deal, it's too late. Now, if you want to bring the target company with you, I think there are some specific issues that Chinese businesses need to worry about, because often Chinese firms and foreign managers of the target firm do not agree on some fundamental tenets of strategy. And this is a particular issue. I'm thinking particularly of some Chinese firms that we've worked with who've acquired targets in Germany. A real failure for minds to meet around an issue of quality versus cost as a driver of strategic value and success. So often Chinese firms are very focused on low production costs and being price competitive. German firms being very focused on quality as a driver of success. How are you going to build a unified culture if you can't reconcile those two differences in the management philosophy for the business? Similarly, short versus long run returns. Often businesses, again, this is a particular issue in Europe, enter into very, very long-term arrangements, long-term contracts, but also long-term strategic alliances. In Germany, for example, very, very long-term labour market agreements. Chinese firms tend to be much more short-term in terms of their operating effectiveness, much more nimble. How are you going to reconcile those two issues to mean that the joint entity can succeed? And similar to that is this flexibility versus predictability. Chinese firms famous for being able to turn on a dime, reorientate production to follow the latest trends in the market. Often Western businesses, American businesses, European businesses value predictability very highly and enter into long-term client relationships, which means that flexibility is more difficult for them. These things, both of those points of view have value. I think the key point here, though, is if you want to present a unified face to the government in the country you're trying to make an acquisition in, you need to iron out these issues between you and the management of the foreign target that you're trying to acquire first. Now, if you can overcome all those problems, the prize is very great. And I think this is where I want to finish my remarks, just by pointing out that China, over the last few years, has become considerably more successful in terms of its international engagement in terms of M&A. We now see, as I mentioned, about 200 deals a year, $40 billion worth of international M&A. So over the last 5 years, there's been a step change in China's international engagement. Some of that is around the acquisition of raw materials. That is clearly going to continue. I would imagine that many of you here today will be interested in what we're going to be talking about in terms of Africa and Latin America because you're interested in the raw materials story. But I would argue that experience, when you look at a way that other countries have emerged and internationalised, is that acquisition of raw materials is not the end game for China. Most foreign direct investment by developed countries, by European businesses, by American businesses, is not about the acquisition of raw materials, it's around market access. European firms, American firms buy firms in Europe and America, and they buy firms here because they want to gain a foothold in those markets to service final demand. They make those acquisitions in industries where they have a competitive advantage. So on that basis, where is China going to be strong? It will not be buying raw materials, it will be in industries where China is likely to have a natural advantage, and China will have a natural advantage in industries where there are big economies of scale to be generated because of the size of the domestic market that we see here in China. So I would expect China to be strong globally over the course of the next 20, 30 years in the automotive sector, where we see a very, very significant domestic demand dynamic which could be leveraged into a good global dynamic. With green tech, in infrastructure, the infrastructure story here, as everyone knows, is very strong, but that creates economies of scale for Chinese firms which they can leverage in the global market, and in technology more broadly. And Chinese firms who are strong in those areas will want to be strong in markets where they think the opportunity is big. And that is not actually sub-Saharan Africa, it's not even the smaller parts of Latin America. The opportunity is biggest in Western Europe and North America. That's where all the demand is. So for me, the end game for China is going to be China having internationally competitive automotive businesses, green tech businesses, infrastructure businesses, which are succeeding in Western Europe and North America. Not the sorts of businesses that we see succeeding in sub-Saharan Africa and Latin America. Those things will happen, they will be, they're going to be an important part of the next 10-year development story, but the end game for China is for China to have firms that look like European and American MNCs, and to be successful in Europe and America themselves. What are the challenges to that? The challenges are identifying opportunities for Chinese firms and the management of the operating issues that come with seizing those opportunities. One of the reasons that we're here today is to talk to Chinese businesses about how we can help them grab those opportunities. We're happy to work with Chinese firms to take those in the same way as for those of you who represent Western MNCs that for many years, for the last 65 years, EIU has worked with you to help you take opportunities in this market. So I think for China, the future is very bright, but it's going to look very different from how it does today. And Chinese firms, many of the firms that are represented here in the room today, are going to be much, much more international than I think many people believe is possible over the next 20 years or so. With that, I think that's all I have to say. I'm happy to take a few questions, and then we'll move on to the next panel, which is to talk much more specifically about China investing overseas. But before we do, has anyone got any questions about any of that, either about China's external engagement or about the outlook for the global economy? Everyone's stunned in silence or too shy to ask a question. There's a chap there in the centre.
Hi, Robin. That's a great presentation, by the way.
Thank you.
My name is George Chung from IBM, and we work with many Chinese resources companies. And currently, we can see that with CNPC, Sinopec, there's been a lot of greenfield acquisition overseas for resources. In countries like Africa, in Latin America, would you see that this trend continues do you see that maybe there could be so many long-term issues, with this trend of development?
Yeah, I think China, at the moment, a lot of foreign acquisition for Chinese firms is about about buying up resources. Will that trend continue? Absolutely. China is the world's biggest consumer of a whole range of natural resources. China is concerned about resource access. Doesn't seem to be comfortable that international markets for commodities are sufficient, so they want to acquire. I think that trend will continue. Do I see issues? Yeah, I do see issues. China faces a lot of political backlash in general when it goes overseas. I think buying up resource companies brings some particular issues because it is so sensitive. I think it's it's an interesting question given that overnight Argentina has just expropriated a Spanish energy firm, YPF, a part of Repsol, It's being debated in the Argentinian Senate today, but it seems pretty likely that that is going to happen. And that's interesting because it's an emerging market economy expropriating a firm which is owned by a Spanish owner in this ultimate ownership structure. So what that tells you is that actually there is a lot of sensitivity, not just about Chinese acquisition of raw materials overseas, actually about all acquisition of resources internationally, and lots of governments viewing, particularly given very high commodity prices, that resources are something they would rather keep much closer to home. So China will face political backlash to its attempt to buy raw materials overseas, and we see that happening already. But nonetheless, I expect China to continue to deploy the liquidity stockpile it's built up here to buy into raw materials. I guess the point I was making is that I don't think it's going to end there. There will be other sorts of international acquisitions, and ultimately in 20 or 30 years' time, raw materials are likely just to be a bit of a sideshow in comparison to acquisitions that China is making in other areas. But for now, raw materials are going to be front and centre of the strategy, and there will be political pressure, but it's not just about China. We're seeing it directed to other countries, and Argentina and Spain right now are great examples of how it can go badly wrong. Lady there? Right there. There we are.
Rather great opening. This is Lian Li from Visteon Corporation, based in Shanghai. For all of the globalization activities and business development activities, a very critical factor driving the success of that is leadership talent and management architecture. So in your observation, as we see for industrial countries investing in China, there's a lot of expatriates leading the work, and succession planning continue to be a challenge and a journey. When you see for Chinese companies going abroad, what's your observations and insights in terms of making sure the leadership talent, the management infrastructure is being designed up front and considered as a very critical factor?
Well, it's a big issue. Just looking, first of all, Western companies coming into China and then using that as a way of thinking about what China might do as it goes out. When you say that Western firms use a lot of expat senior management, that's clearly true. If you look around this room today, there are a fair number of Western faces in it, and I suspect that they're all running Western businesses over here. But I would say that the trend has moved a bit in that regard. That certainly 15 years ago, most Western businesses are operating in China. The whole of the top of the management structure here was Western staff. That is gradually changing, and we're seeing that in order to succeed here, it's not just a question about developing talent. There's certainly an element of Western businesses developing Chinese talent within their organisations and allowing it to be promoted up. But I would say it's more than that. There's also a sense here that in order to understand the market needs fully in China, that Western firms have realised that they need to have more senior Chinese people running their operations here in China. And I would say that some firms have got even further than that, that ultimately the managing director or the CEO of the China operation is Chinese for a lot of Western businesses now. And increasingly we are seeing Western businesses who have big revenue streams here in China actually have the Chinese CEO, who is Chinese themselves, sitting on the global board. And so I always think the interesting way to think about this is to see where there's a foreign company owning a Chinese subsidiary, at what point does the nationality of the management structure flip from being Western to being Chinese? It used to be several layers down within the Chinese hierarchy. Now it's quite often at the point between the regional manager and a local head of the Chinese business, and in some firms now we have Chinese nationals serving on the board. So there has been a bit of a shift. What does that mean for Chinese firms? I think what we're seeing in the first instance is that we see Chinese managers being sent overseas to help run these acquisition targets. And they do that because they are unclear how to get the best out of the target that they have. They've required it because they believe they can drive value, and in order to do that, they want to bring some of their best practices from China out into the local acquisition. But I suspect that the end game will be rather similar to how Western businesses have found their end game in China, which is that over time what we will see is that the European subsidiary of a big Chinese firm will be run by Europeans, and ultimately there may be Europeans sitting on the Chinese board back here in China. So I think there will be a transition. In the first instance, you'll see a lot of Chinese business people sent overseas to run these operations, but over the course of the next 10 or 20 years or so, you'll actually see that European or American heads of these subsidiaries will then end up sitting on the Chinese board. And Huawei is a good example of that, actually, because their CTO is an English-American guy. Now, clearly, Huawei, their CTO used to be Chinese. Now it's an English-American guy because their biggest markets are outside of China. So their management structure has changed in order to reflect the strength of their presence overseas. So I imagine that will be true for many other Chinese firms. So initially, foreign operations run by Chinese, but in the long run, foreign operations run by Westerners. Got time for one more question. Gentleman there.
Okay. My name is John from the Baosteel Group. As you know, the last Friday, China National, the Bureau of the Statistics announced the first quarter GDP growth is 8.1%, which is out of expectation of the market observers in response to the low GDP growth rate the first quarter. The steel future of the Shanghai exchange also slide a little bit, and the commodity market also experienced some little bit decline. So we are wondering, as the steel maker, we are wondering if the commodity market is entering into the so-called declining pattern compared with the past 10 years. As we know, in the past 10 years, in response to China's strong demand for the commodity, this world's commodity market enjoy very the happy time, the high price, and the strong demand. So would you expect, in the next 10 years, the world commodity, including iron ore, coal, nickel, everything will enter into the decline in the pattern? Thank you.
Yeah, well, the good news for you is that I'm more optimistic than that. So Baosteel probably doesn't have to worry too much. Chinese economy is slowing. I mean, interestingly, the markets were horrified that China was slow to 8.1. That was actually a bit better than we were forecasting. Our China Access China team thought it would slow to 7.8, so we were pleasantly surprised. Important to recognise that the Chinese government is deliberately trying to slow growth here. So policymakers are actually quite pleased. This is pretty much in line with what they wanted to achieve. To ruin your first coffee break, our view is that China will slow further in the second quarter, so we think there's more slowdown yet to come. But we don't expect to see a hard landing in China. We think you'll get a recovery in the second half of the year, and I think actually the more important long-term issue for commodity markets is going to be what happens to China and other emerging market growth over the course of the next 10 years or so. And our view is that growth will remain relatively robust in the emerging world. If you think about why global demand for commodities has been so strong, it's not really because we've seen China become the world's production powerhouse, making products which are being sold in the West. I mean, that demand was always there. Where the goods are produced in the world is not an important factor in terms of demand for commodities. The really interesting thing which has happened in the last 10 years is that the development here in China, the economic development in China, and to a lesser extent in India, has added perhaps about 500 million, maybe even as much as 750 million new consumers to the global economy as people have been sucked out of subsistence agriculture and into the more formal consuming society. And that big increase in the population of consumers around the world has led to an enormous increase in demand for consumer products, things like cars, things like scooters, things like TVs, things like residential real estate, and that has lifted demand for raw materials. And our view is that that's a structural trend, that actually we will see more people lifted out of poverty and therefore becoming active agents of demand for consumer goods, and that will keep demand for raw materials rising more rapidly than global growth overall. So our long-run expectation is that actually commodity markets will remain pretty good bets. Though clearly there are demand and supply cycles, and we see investment in raw material supply, mining investments and the like. But I think the long-run story is pretty good, and we shouldn't allow the fact that Chinese government is deliberately trying to achieve an economic slowdown to put the lid on inflation to distract attention from this long-run trend, which is that as people are lifted out of poverty and become active agents in the global economy, that raises demand, and that's good for business. It's good for all businesses, particularly good for raw materials businesses, but it's actually good for everyone, for autos, for tech industry, for the energy industry, for pretty much every industry. Having more people in the world that consume product is a good thing. China, and to a lesser extent India as well, have helped to achieve that. That suggests to me that the outlook for businesses which support that kind of demand trend is pretty bright. So I'm not too pessimistic, but I would say that we think China will slow a bit further before it gets better.